This is 8-Minute Market Structure by Texture Capital, bringing you concise, expert insight for better markets. And now your host, Richard Johnson.
Hello, my name is Richard Johnson. I'm the founder and CEO of Texture Capital. We're a FINRA member and SEC-registered broker-dealer specializing in digital securities. We help institutions more efficiently and directly participate in private markets, providing tools for tokenization, issuance, and secondary market trading. Welcome to the third episode of 8-Minute Market Structure, where I speak with industry experts and get their take on the most important market structure issues. It's a simple format, the same question for every guest. If you're building a new market structure from scratch and could change one thing, what would it be? It's one topic, no prep calls, just 8 minutes of concise, expert insight for better markets. Today's guest is Bill Harts. Bill has a 30-year career in capital markets, including serving as head of corporate strategy at NASDAQ, managing director and head of strategy for equities at Bank of America, and as CEO for the Modern Markets Initiative, an advocacy group for electronic trading. Currently, Bill is the board member for ACTIV Financial and an active commentator on Twitter, which is in fact where we met. This is the first time we've met in person, Bill. So welcome to the podcast, and thank you for being one of the early participants.
Thanks very much for having me.
Yeah. It's safe to say that you know a thing or two about market structure. So let me put the question to you. If you were building a new market structure from scratch and could change one thing, what would it be?
So let me just start by saying that, and I just want to sort of set expectations a little bit. I'm always leery about proposing changes to market structure, especially when you start out by saying, well, if I could just change this one little thing, everything would be great. Because generally, changes in general have unintended consequences, and they really have to be carefully thought out. But what I'd like to suggest is a change that would maybe go a long way towards resolving some of the conflicts between off-exchange and on-exchange trading that we see today. So let me get into it really quickly. So first of all, I think most people would agree that off-exchange trading has turned out to be a boon for retail investors. Market makers who provide the service have essentially revolutionized the business and enabled millions of investors to trade commission-free. But what's good for retail may not necessarily be good for display price discovery, especially when an institution has a natural order that may improve the NBBO. And as we've seen, because of current market structure, institutions are increasingly unwilling to display their orders, knowing that they may not interact with this retail order flow. And that leads to fragmentation and other unwanted side effects. So I would implement a simple change. And again, I say simple, right? But why don't we do this? So let's change structure such that we require off-exchange market makers. So if you're going to execute off-exchange, that you're required to check the price for that particular stock at that particular time on at least one non-affiliated market center before you trade as principal. And if that market has a better price, then execute that price as risk goods principal, pass the price on to the retail customer. If not, continue as we do today. And in that way, both retail and institutional investors would get the best price, and everyone else could see what happened when they see the tape, the transmitted last sale on the tape. And so that's the overall gist of this. Let me elaborate just a little bit. So by checking prices, I mean that I sort of envision that market makers would have a standing virtual market data display of routing destinations, which would include exchanges and ATSs, and they use that to determine where to route before they route. So let's get rid of so-called pinging to find hidden liquidity. I think that's all counterproductive. Remember, the idea here is to encourage more displayed liquidity and more interaction of liquidity. So I don't like the idea of searching through a bunch of different markets, especially for a 100-share order here or there. And by the way, pinging also might cause the market maker to miss the market, and it leads to a whole bunch of other problems. So essentially, market makers would be able to check prices and route if there was a pretty good chance that they'd get filled. Finally, for this to work, you'd allow ATSs to display some kind of indication of interest, probably as a private feed to the market makers. I'm not talking about a full quote. I'm just talking about maybe side and the fact that it's better than the NBBO. And this would encourage institutions to participate because they know that the full extent of their order wouldn't be revealed. And I think in this way, we could bring together institutional and retail flow and still maintain that role for the market makers and sort of bring the best of both worlds to the table.
Interesting, Bill. So to summarize that, I think what you're saying is require the market makers to check an unaffiliated exchange for the price. How is that different to the trade-through rule that we already have in place right now?
So a couple of ways. First of all, I want to be clear. I'm not saying just exchanges. I'm saying market centers. So that would include ATSs as well. And I think it's an important distinction because, first of all, so much liquidity has become hidden these days. And I think what we haven't really addressed is why are institutions so reluctant to display their intent, and how can we help that? And I think the idea has something to do with allowing them to display in an ATS and having that ATS be able to display private quotes. Now, if an institution wants to display its order in a registered exchange, of course they can do that, and of course that order will be protected. But the problem is they don't want to. They don't see. We see institutional basically abandoning stock exchanges and going to dark pools.
Right. So to clarification, there, it's different from the trade-through rule because they're checking. Is it one market center or multiple market centers? And then the bit at the end where you're saying, and how do ATSs get involved in this? So basically, if an ATS is showing a better price or on its internal books, or it could be a dark pool, they would route to that instead and deliver the better price to their clients. But is there a requirement for them to check all the ATSs, a number of them, do you think, in this proposed idea?
No, I think not. Although I think most market makers would build in the technology so that they could look at a variety of different venues, exchanges, and ATSs, just because they want to do the right thing for their clients. And I think you'd see that, but I don't think it's necessary to enforce that by rule. I think that the market makers are going to do what they feel is best for the client.
Right. Okay. What about?
And remember, the more exchanges or the more ATSs that they're required to check, the more things can get delayed. And the problem is some ATSs and exchanges, by the time they send an order there, it may be gone. They may have a very low fill rate. And so market makers need to take all these issues into account before they route somewhere.
Yeah. Do you think there could be concerns from some of these ATSs about letting the proprietary trading ATSs get a first look at what they have on their book and then potentially not trading it? So there's some kind of information leakage potentially.
I'm not sure I understand the question.
Well, you're saying that they need to check another market center, which could be an ATS, which is a different structure, of course. The ATS could be concerned that they'd be giving out information about their order book, and then perhaps the market maker would back away, or is there some requirement to stand up here? I
understand. So I would say two things. First of all, I would give the institution whose order is on the ATS the ability to opt out. Number one, and number two, I think there's sort of a careful line that you have to draw in terms of what information you actually send out on your indication. So I don't think you send price, and you certainly don't send size. Maybe you just say, if I'm sending out this indication, I have an order that's better than the national best bidder offer, and it's either a buy or a sell, something like that. So you don't give out too much information, and hopefully, the institutions are comfortable with that. It's a delicate balance, and I think you'd have to talk to the institutions to see what they would be comfortable with.
Great. That's a very original idea, Bill. We could go on, but then it wouldn't be called 8-Minute Market Structure. We will continue the discussion on Twitter and social media, and I'm sure we might get quite a bunch of comments from the Market Structure Twitter universe. Bill Harts, thank you very much.
Thanks so much, Richard. Thanks for having me.
This has been 8-Minute Market Structure. Be sure to follow Texture Capital on LinkedIn, where we will release a new episode every week. You can also find us on Twitter at texture_capital and on the web at texture.capital. The foregoing discussion is for information purposes only and does not constitute a solicitation to buy or sell securities. Private securities offerings are not registered with the SEC and are considered highly speculative. An investment in private securities may result in the loss of your entire capital contribution. Blockchain is a new technology and unproven in financial markets. There is no guarantee that tokenization will enable any secondary market liquidity in the future, and your investment may remain illiquid.